Excellent. Well, good evening, everybody. I'm sorry we can't be meeting in person, but I am hopeful that the technology will allow me to communicate almost as well as if I was with you in 3 dimensions. So I'm going to start from the perspective that many of you won't know Impax Asset Management and give you a thumbnail of what we do, and then I'm going to summarize our annual results for the 12 months to the 30th of September. So Impax Asset Management is a investment management firm. We are a boutique, which means that we've got a particular focus. And that focus is that we believe that what we call the transition to a more sustainable global economy is leading to real opportunities, enormous opportunities for making money over the next 5 to 10 years. Those opportunities arise from high rates of market growth in areas such as the clean energy transition, the move to 100% renewable energy, which is what we're likely to see over the next few decades, the move to low emission transportation, the adoption of energy efficiency and resource efficiency, and even more efficient and less polluting forms of food. So we've been doing this for over 20 years. We've got over 220 staff, 66 of whom are investment professionals. And what that really means is that we're one of the world's largest teams dedicated to this idea of the sustainable economy, which is, of course, really attractive when it comes to pitching to clients and prospective clients around the world. Now, our clients are pension funds, they are sovereign wealth funds, insurance companies, and private banks. And a crucial point about us, if you're comparing us with other boutique investment managers in the London market, is that 75% of our client base is outside the UK, which does make us quite different and gives us a very nicely diversified client base. And our business model, our business idea is to grow our business organically, principally. So we are intending to scale up the business, selling more of the tried and tested products, which have been working very well for clients for many years, as opposed to making lots of acquisitions and bolting on bits and pieces to a single platform. So our global distribution is something that's taken a very long time to put together. We have direct sales teams in the UK and the United States. Over 40% of our staff are based in the United States, with most of the rest being in the UK. We have small offices in Dublin and Hong Kong. But outside the US and the UK, we have investment partners such as BNP Paribas Asset Management, who distribute our products in continental Europe, and then other partners in places like Australia. Highlights for the 12 months to the end of September included an enormous increase in scale, so 84% growth in our assets under management to just over £37 billion and record net inflows, i.e. new capital to manage of 10.7, which obviously was over a quarter of that year-end total. Got a really highly attractive market context. We have enjoyed very strong investment performance, and we've got a robust platform for further growth. Financial highlights on this slide. So you can see in the dark blue lines where we were in typically £1 million on most of these charts for the 12 months in September 21. The light blue lines are for the previous year. So you can see just by eyeballing left-hand side a very strong increase in revenues and profit. On the right-hand side, you can see the growth in the assets under management over the year. And then the bottom chart on the right shows the strong growth in the dividend per share to 20.6 pence for the financial year. In the blue box at the bottom, you can see the progress that we've made just in the first 2 months of the new financial year, so October and November. By the end of November, we got to 39.8 billion compared to 37.2 just 2 months previously. So a very strong start to the new financial year. The market context is very attractive. I think post COP26 climate conference and with the Biden infrastructure bill, there's very strong momentum behind the growth of markets that I've referred to before. Number of investment opportunities expanding really rapidly, areas such as energy efficiency, pollution control, water treatment. And it's not just small companies in the space, it's now large companies that are pivoting to these highly attractive markets. These trends have not gone unnoticed by major asset allocators, pension funds and insurance companies that I mentioned before, etc. So this is red-blooded capitalism, but also many such investors are motivated by values or ethical views, including their commitment to net zero in a climate change context. And in that regard, Impax, of course, is very well positioned because of our single focus, our perceived authenticity, our strong and stable team, we have very low staff turnover, and our distribution network, which is well tried and tested through many years. The results show very strong growth in the UK and Ireland, notably a big mandate with St James's Place, which has grown dramatically. In Europe, we've seen very strong inflows from BNP Paribas Asset Management, and in Asia Pacific, big news around a new partnership in Australia with Fidante, and in Japan, seen a lot of new business originating from Nomura. And in North America, probably the most exciting area for growth in the future, we've grown our own so-called PAX World funds network very significantly. We've got new mandates, including for ERISA clients, which is a particular channel within the US pension fund market, which is enormous if you can get it right. And we've just got our regulatory requirements in place for that. And we've just hired a new experienced head of sales and marketing to lead the North American distribution. So he's spearheading a big push forward in the US and Canada. If you eyeball this next chart, that shows our investment performance, the blue line showing the performance of various strategies over 1, 3, and 5 years compared to the grey lines, which is the benchmark, if you like. So in most cases, we're significantly ahead of benchmark over those 3 time periods. The only fund which is a little bit behind is our sustainable food fund, which is more a value-oriented product. And what I just showed you was the thematic range. This is our less thematic range, the so-called sustainability lens strategies, which is global opportunities, the product we run for St. James's Place, coupled with the 4 products that we run for out of the US in equities and fixed income. So again, blue lines bigger than grey lines is good, because it means we're outperforming and meeting clients' expectations. This next chart shows the breakdown of our client base, assets under management, first of all on the top left by product. So we're well diversified by product that we run. The breakdown by client type is shown in the bottom left. So we've got 41% of our assets, 32% of our revenue from BNP Paribas. But other than that, we've got a very broadly based client base, our own funds that we sell, as I mentioned, in the UK, continental Europe to some degree, but also in the US, that's the Impax and PAX labels, and then other mutual funds and segregated accounts that we're typically running for other people. And then the top right shows the breakdown by geography. So the UK and Ireland, 25%, as I said, and then North America is 25% at the moment, and the EMEA region nearly half. The 12 months to the end of September was characterized by strong flows across the board. So if you look at this chart in 3 columns, the left-hand column is the UK and Ireland, dark blue bars compared to the previous year. So you can see St. James's Place there, a very strong increase. In the middle, BNP Paribas, strong in all 5 funds that we sub-manage for them, including the Global Environment Fund, which is where the Nomura money went. That was over $1 billion out of 1.6 billion pounds in global environment, new money. And then on the right, in the middle, the North America bar is worth calling out. Pax World funds and the Delaware funds, etc., showed very strong increase. So what are we looking to for the future? Well, organic growth is the plan, scaling up our existing strategies where we've got significant capacity headroom. We've got an expansion of our direct sales team underway. We do, however, have a track record of developing new products pretty successfully. So we've got a couple being seeded at the moment, and we have several other ideas on the drawing board. And meanwhile, our private markets business has had a successful exit from most of Fund 2. It's starting to divest Fund 3, and it's had a first close of the 4th fund just about 6 weeks ago. We are investing very heavily in the people of the firm, so 220 staff today. We've increased headcount by nearly a quarter in the financial year just reported. We've got a very, very strong and loyal employee base. So we had a staff survey which produced a 88% engagement score, which is very high. Our COVID work plans are evolving, but we're aiming to be a primarily office-based culture by the time that we settle down, hopefully in the new year from the latest variant. We've built out our team in Dublin, which is our EU post-Brexit landing pad, and our work on diversity and inclusion is aiming to be top of the tree in terms of aspirational targets and performance around gender mix and bringing on board and nurturing talent, particularly from ethnic minorities. As we aspire to build the business looking to the future, then we are putting in place a plan for expanding our systems, policies and procedures, strong focus on risk and compliance, which is at the heart of the success of these sorts of businesses. And we are systematically working through execution plans for growth of the business with a 2025 vision with the snappy title Impax 2025, which is galvanizing planning across the various departments of the firm. So just in summary, then we do feel as though the context of a increasing set of, or rapidly expanding set of opportunities to deploy capital as the economy transitions towards clean energy, clean transportation, resource efficiency, etc., then Impax's authenticity and strong brand really stand out on a global basis against the competition. We do have a well-established distribution network and a well-established set of investment processes. Our team is very loyal and almost no involuntary staff turnover, and it's a very resilient team that's proven itself very capable of working remotely through the pandemic. We've doubled in size as a business since the pandemic struck in March last year. So looking to the future, then the market drivers continue to strengthen. The allocations by asset owners are ticking up, and our pipeline remains very healthy. And we do believe that we've got plenty of scope for further scaling of the business organically, while at the same time not being blind to the opportunity to acquire other businesses. We did make a successful acquisition in the US in 2018, and as a result of that, we're able to take what was a very small footprint in the US to nearly 40 or just over 40% of our headcount, as I mentioned before. So I think that's a good place to pause. Look forward to some questions, and back to the moderator.
As a reminder, send in your questions via the question box, and we'll try and get through as many as we can. Okay, first up, what impact, if any, did the COP26 summit have on the business?
Well, I think what the COP26 Climate Summit did was it reinforced the perspective of business and finance that climate change was serious as a policy issue, and the commitments made by businesses and finance players at COP26 were very encouraging in the context of cementing the expectations around growth for the markets in which we're investing. That set of announcements and news flow was very much on the radar screen of current clients and prospective clients. So I think both the expectations of expansion in the real economy and the expectations of further allocations from those wanting to deploy capital where Impax can provide some service were both strengthened by the conference. So yeah, overall very positive.
Do you feel, question for me, do you feel as though the summit was a success?
Well, I think if you judge it from the perspective of the policy as opposed to business or finance, then yes, I think a qualified success. It was never realistic to expect that the commitments to solve climate change would all be cemented in a 2-week process. But what was put in place was a number of initiatives at the grassroots level. So we had the first major commitment to reduce deforestation and eliminate it by 2030. We had the first major commitment to reduce methane emissions. We had a slightly watered down but still very encouraging commitment to phase down coal-fired power generation. And there were several other initiatives as well around, for example, clean transportation. So the best way I think of looking at COP26 is that it was the firing the starting gun of a number of policy initiatives which need to be deepened and strengthened. We'll be back as a policy, or the policy community will be back in 12 months' time to make more progress, and there'll be a lot of hard work to be done between now and then.
Next question is about kind of culture, I think, in North America. And you talked about your US acquisition, which is kind of embedded in now. Culturally, the movement to more ESG investing in the UK and Europe is quite well documented. Is it the same in North America? And are there the same movements to ESG type investing in the US than we're seeing here?
So let me sort of tease apart two things. So there is definitely a class of investors who just want to invest in the next economic trend on a purely sort of objective basis. There's a second group of investors who are keen to do that, but at the same time to qualify or filter their investments according to some kind of criteria which could be labeled as ESG. So the trouble with ESG is it's not a very well-defined issue or discipline, so it means different things to different people. But in Europe, the key issues around in this general space are around impact measurement, so what kind of non-financial outcomes does the portfolio produce, alignment to the Sustainable Development Goals and demonstrating that, and also net zero, which is emerging as an issue, but questions around the sort of underlying emissions of the portfolio companies and whether they add up to a net zero position now or at some point in the future. In the US, the topic, this general topic, is less well defined and not as nuanced, and ESG tends to be the sort of default label, and is a bit of a sort of a focal point for these discussions. So much so that the regulator, the Department of Labour, in one context governing the pension industry, is ruling about whether ESG can be taken into account. So I think, in summary, Europe and North America are looking at these non-financial issues differently. ESG is definitely the lingo in North America and probably will be for a while. Europe is moving beyond ESG, I think, into these slightly different categories. The critical thing is that Impax is able to provide the information and reporting, no matter what the language of the question is. But underneath all that is some excellent investment discipline and some great risk-adjusted returns, irrespective of the values or ethics that the underlying client's demonstrating or requesting.
Thank you. Next question. What types of businesses are you looking at when you talk about sustainable agriculture?
So in the sustainable agriculture space, the obvious place is just efficiency. So 30% of food is wasted between the field and the plate. And there's ways that you can improve efficiency through smart application of seeds, fertilizer, and water using telemetry and satellite imagery based systems. There's packaging improvements that can save on waste through the logistics of distribution. And then there's opportunities around moving beyond efficiency. There's opportunities around new types of food, for example, plant-based meat substitutes. There's also a sense in Europe, or continental Europe at the moment, that sort of food carbon footprint is an issue that consumers are starting to get interested in. So low mileage food distribution chains and products that have got low emissions associated with their growth and distribution are also areas of interest. So yeah, it's a intriguing and rapidly expanding area.
Next one. Please, can you talk a little about your major shareholders? For those owning, say, 5% plus of the company, who are they, please?
So the largest shareholder is BNP Paribas Asset Management. They own 14%. I don't have the definitive list with me, but I do know that funds run by Aberdeen Standard, Aberdeen as it's now called, and by BlackRock own declared stakes. I'm pretty sure that the funds run by Lion Trust own a declared stake. Beyond that, I probably shouldn't guess, because I'm not quite sure who's declared and who's not declared. But I own 7.5%, so I'm in that category above 5%, and I think a couple of my colleagues are in that category as well. So management owns just over 20%. Best way of thinking about the shareholder base is the management owns just over 20%. BNP Paribas owns 14%. There are a number of small and mid-cap oriented funds run by well-known UK brands that I've mentioned that own declared share tranches, i.e. above 3%. And then there's a long tail.
Okay, next question. You're currently AIM listed. Would there be any investor benefit to move to the main market?
Well, obviously there are benefits of being on AIM, including inheritance tax benefits. I think we're in the top 10 now by size of AIM companies, there or thereabouts. So we do get quite a lot of visibility on the AIM market. To move to the main market would entail quite a bit of additional cost and reporting process, which at the moment we don't feel that there's any need for that. There may be increased visibility and liquidity, but equally we may lose profile and interest, because we'd be at the sort of the lower end of the 250 rather than the top end of the AIM market.
So there's, just to clarify, there's, as much as you can comment, there's no plans to do so?
No, we don't have any plans to do so at the moment. We're always interested in feedback and suggestions as to whether that will be a good idea. But for the reasons I mentioned, we're not minded to do that anytime soon.
Thank you. Next question. Increasingly, asset managers seem to be scrambling to add funds and products to address ESG investor demand. Do you have any comment about legacy providers trying to add these sorts of funds to their portfolio of products?
Well, there's some very capable investment management groups out there, and it's not pass them by that the new industrial revolution in these areas that I mentioned is underway. So many well-established generalist managers are starting to invest in clean energy, clean transportation, etc. Some of them are trying to launch or are launching and have launched specialist products that would fit into this sustainable development category. There tends to be quite a wide spectrum of underlying portfolios, some that are pure play, like Impax, and others that are much more well diversified and maybe have limited direct exposure. So I think the advice to the outside investor considering these products is really just to do a bit of research and get under the skin of what exactly is being proposed. Don't invest just because the name sounds attractive or relevant. You've really got to understand where the investment managers are positioned, where they're getting their ideas. And if they do appear to be focused like Impax is in this area, then an obvious question would be, well, what sort of resources do they have and what sort of track record do they have?
Okay, next up, what would you say your funds can achieve that can't be replicated by an ETF?
Well, I think we do find in the US that there are ETFs, for example, in the renewable energy space or the water sector, and they perform perfectly well. But what we're able to do is to apply our investment management expertise, particularly around valuation, and identified companies that are not correctly valued. Typically, obviously, we're long only, and therefore we're looking for undervalued companies. So if you compare our performance against baskets of stocks in this space, then generally you're seeing some alpha, some outperformance because of that, the advantage of stock picking, which comes from applying expertise around market growth rates, around ability for companies to improve their earnings and dividends, etc., and compute through that share values, which are intrinsic values, if you like, which are above what the stock market price is showing. So yes, there's definitely a role for ETFs in this area, but I think we're pretty confident we can continue to outperform them.
Next up, could you talk to the dividend policy for Impax?
Yeah, so we pay 2 dividends a year, and our policy as of a year ago is that we will aim to pay between 55 and 80% of distributable profits out in dividends. And last 2 years, we've been at 60%, so within that range, but at the lower end.
Ian, I think we're done then. Thank you very much for joining us this evening. Thank you for giving us the update.
Great, thank you for having me. Nice to see everybody.